Hello again, and welcome to another video in our series of walkthrough videos for Sea Grant's integrated financial model for kelp aquaculture. In prior videos, we've gone through in detail all of the pages of this worksheet that are coded in red here. These are all the pages where the users will enter inputs in terms of their business model, what they're going to be doing for a business, in terms of their startup costs for whatever kind of operation they have, whether it's a standalone nursery, a standalone kelp farm, or an integrated operation. Users will input information about their operating expenses, what they anticipate needing to spend to actually conduct their business, including overhead. And then users will enter information about what they're bringing into the business, the value of the assets that they're bringing in, if any, and how they're going to pay for all these startup costs. Now, all these user inputs go through a standardized process for financial analysis, which flows out into standard financial outputs. And today's video is going to be focusing on these three over here: cash flow, profit and loss statement, and balance sheet. These are the standard financial statements that any banker would want to see if they were going to assess whether to provide a loan. And they are the standard financial statements that you should review very closely to determine whether this is an appropriate use of your time and financial resources. So we're going to jump right to these, and let's start with the profit and loss. Okay, so here's the profit and loss statement. It's also called an income statement, and this is 3 years of projections quarterly. Our years start with quarter 3 to sort of reflect the life cycle of the kelp. If you're doing a nursery, you kind of need to start that up in the third quarter of the year. You will get revenue from your nursery operations, from your seed string, in quarter 4. And then if you're also doing a farm operation, your revenue will come in quarter 2, in the spring of the following year. Okay, so that's the top line of an income statement, is your revenue. The second section of a standard income statement is the cost of goods sold, the direct costs associated with creating your product, in which case we're calling hired labor and consumables. This is the cash that you are going to need to come up with to pay your people and to pay for things like seed string if you're running a kelp farm. Okay, so those come in during quarter 3 and 4 for nursery, and they come in during quarter 4 and then quarter 1 and 2 of the following calendar year. So the final 3 quarters of our operating cycle. So the revenues minus your cost of goods sold gives you what's called the gross margin, which basically is the leftover that you have that you can use to pay all of your other expenses, including utilities and any kind of rental or occupancy costs, the cost of your vehicles, etc., all the cost of your marketing, permits, and whatnot. So that's what all these items are down here in your operating expenses. And that gives you your what's called EBITDA, earnings before interest, taxes, depreciation, and amortization. And this is kind of an operating income. This allows for bankers or other interested parties to evaluate the economics of your business separate from these other expenses, including depreciation and interest expense. After you take out depreciation and interest expense, that gives you your net income before tax, and we have left out any consideration of income tax at this time. And your profit before tax is really a very, very important metric for the viability of your business, obviously. Now, what I'm going to do right now is I'm going to open up a second page to view, and I want to talk a little bit about where these numbers come from in the income statement. Okay, I've got our views set up right now so that you can see the income statement over here on the right-hand side that we were just looking at. And on the left-hand side, I've got one of your input sheets that you will have entered information into. And so I just want to show how you can kind of dissect where these numbers come from. I'm not going to go through every number on this page, but I do want to take a sec and show you how to reality test whether these numbers make sense or how they make sense, okay? So right here I've got a revenue value here of $25,000 from seed string. And if you look up into the formula bar up here, you see that this is multiplying the value in the D31 in the startup nursery page over here. So here's our startup nursery page, and here's D31, which is 10 tanks. And then it's multiplying that by H31 in the startup nursery, which is 50 spools per tank, so that's 500 spools. And then it's multiplying that from an item on the business model page E30. And then it's also multiplying that by 200. So let's go on the business model page and see what's in cell E130. Now, I already have my cursor scrolled approximately to that line, but as you see, right, we can't see anything in cells E130, right? It looks blank, okay? But as I move my cursor to that cell, I see up there in the formula bar that there is something in that cell. And what I have done on these input pages, for the sake of sort of simplifying the model, is I've taken and put formulas in here where the font is the same color as the background, so you can't see it. So let me show you what I mean. Now, I can't change the font right now because I've protected this sheet, right? All you got to do if you want to see what's in some of these hidden cells, you go into the Review tab, unprotect the sheet, password is 1234, there it is. Now I can go ahead and change the font in these cells to something that'll allow me to see what's in the cells. And so we can see, here's the price per foot of seed string produced. So it's 25 cents a foot. So the price per foot, if we're selling a spool for $200, the price per foot that we sell is $1. But if we're only selling 25% of our production, okay, that means that the effective price per foot produced is 25 cents. So that's how this model works, right? Everything that you put in as a user kind of gets crunched through and simplified and then brought over into these financial outputs in a standardized way. Okay, the next of these financial reports that I want to discuss briefly is your cash budget, your projected cash budget. And again, this is somewhat different from the income statement for a couple of reasons. The primary difference between your cash budget and your income statement at this point is that your income statement or your profit and loss contains depreciation. That's how you account for all that money you spent up front. You spread all that money that you spent up front across the number of years that the asset is going to live. And so that becomes a non-cash expense because you already spent the cash at the beginning. Okay, so depreciation is a non-cash expense, and so quite often there can be a significant difference between an income statement and a cash budget simply because of depreciation. Also, you'll notice if we just quickly look over at the profit and loss or the income statement again, you'll notice that we have interest here, and our interest expense in the first quarter is $997 just for interest. But in our cash budget, we've got loan payments totaling $4,100. Okay, and that's because, of course, part of our loan payment involves paying off the principal. And so a loan payment, just like just like our mortgage payment, part of it is interest, part of it is principal. We have to pay the whole amount, but we can only deduct the interest portion from our profit. But we do have to take into account the full amount of the loan payment. So that's the other significant difference at this point between a cash budget and an income statement. Now, the other thing here in this cash budget is that this is where you can plan for new fixed asset purchases, for any additional inventory you may want to plan for, and also where you can plan for your owner's distribution. Okay, in the income statement, we are not counting your sort of implied hourly rate in that, right? The only thing that is coming out of your cost of goods sold here is the hired labor. Okay, there's nothing in here for owner's salary. Okay. Owner's payment to owners has to come out of your cash budget, and it reduces your overall sort of retained earnings from one year to the next, but it doesn't go into your profit and loss. Okay, so that's the difference between a cash budget and a profit and loss. This cash budget does allow for you to enter your assumptions about new fixed asset purchases, any owner's distribution that you want to plan for. Okay. The other thing is you'll notice that here in these reports, because the way that I've laid them out, the report itself is in a white background, so I have signified that the user input areas are actually in this sort of tan color. So keep that in mind. Okay, the third financial report is the balance sheet. And a balance sheet basically indicates what you own and what you owe. So this base period balance sheet is derived as a combination of inputs from your funding page as well as from your beginning balance sheet. So again, let's go ahead and open up a second window so that we can see what is going on here and where these are picking up from. Okay, so here we are. We've got our beginning balance sheet. So these are the assets that you are bringing into the business. You said that you were going to bring in $5,000 in cash. That's what's showing up over here. You said that you were going to bring in $1,000 of inventory, which is part of what's showing up over here. But in this case, this 3030 is not the same as this 1,000. So let's take a peek at the funding page and see where that's picking up. So we're looking for line 45, which is here, our supplies and consumables. So that's sort of your beginning balance sheet, your inventory and supplies. And so our other current assets is basically the permit. We're considering that to be an asset. Continuing on then, the fixed asset portion of the balance sheet picks up again from the funding page, which flows from your startup pages. So that is where all these numbers come from, and we wind up with a total asset value between what we brought into the business and what we're buying new of $122,000. Okay. Now, how are we going to pay for that? We're going to pay for that with, again, this is our funding page. So here's our commercial loan, right? Here's our vehicle loan. And then our owner's equity investment is the combination of this $20,000 that you and your buddies are contributing here and what's showing up on the beginning balance sheet as this $31,000, right? Which includes the value of your vehicles. Okay, so now I want to talk about the relationship between the balance sheet and the cash budget. Okay, so as I was mentioning, in the cash budget, you have the option to plan for new fixed asset purchases, any additional inventory that you might want to plan for, as well as planning for your own pay, so that the owner's distribution. Let me just show you how that flows through to the balance sheet. Okay, so if you decide, say, in the second year of operation, at the beginning of the year, Q3, that you're going to spend another $5,000 on some fixed assets of some sort, new equipment. Okay, in your cash budget, you can plan for that here, $5,000 purchase. And what happens is, first of all, right, at the end of the day, we're assuming, I'm not getting into like, financing new fixed assets or things like that. That's not the purpose of this. But if you plan to purchase a new fixed asset, what you'll see is that shows up over here in your ending year 2 balance sheet as a $5,000 increase in your fixed assets, and the corresponding $5,000 reduction in your ending cash estimate for year 2. Okay, which is here at Q3, at the end of Q3 in year 2. Okay, so that's how your new fixed assets. Likewise, if you want to pay yourself, let's say you're going to take a payment for yourself of a couple $1,000s in the first year. Okay, there it is. You've got now less cash, and the owner's draw shows up here in the year 1 balance sheet. Okay, so that's how your balance sheet is related to the cash budget. Okay, and then the other thing to note, and we'll do more with this as we talk about what if analysis in subsequent videos. But all of this, of course, flows from your assumptions about your sales volume, your revenue, your expenses, things like that. So if we go here to our startup farm page, which is where we entered all the data about how big this thing is going to be, how many lines we're going to have, and you say, you know what, I need to go big. Now watch what happens. The important aspect of this is basically the total equity, the total owner value of the business is what we're interested in. Okay, this $92,000 at the end of time, that is the value of the business. It's a combination of what you originally put into it, the earnings or the profit that you've kept in the business, and then you take away, you subtract from that if you're going to take a draw. But the bottom line is, if you're in business, you want to be increasing the net worth of the business. Okay, so this ending net worth here, this $92,000, is the number that we're really interested in. Now, what happens to that number if I just grow more kelp? If I change my lines to 40 lines instead of 20? Okay, it increases. It didn't double, but it did increase. Okay, now you can't obviously just change your lines. There are many different values that need to be flown all the way through the model, but I did just want to demonstrate how responsive this kind of a financial model is to changes in inputs. And that's going to be the topic of the final 2 videos in this series. What happens? What if analysis for your model. Okay, so that's the end of this one.